Hello, everybody. My name is Christian Leonardo Sanchez Camacho, and this is my project on the financial management project of Sony versus Nintendo. This is for my finance 403 section 01 and my professor Chatterjee. To begin with, the purpose of this project is to analyze the financial statements of Sony and its competitor being Nintendo. Now, to facilitate the analysis, I utilize several financial ratios and accounting measurements, such as quick ratio, which is going to be listed above. Quick ratio, current ratio, inventory turnover, account receivable turnover, fixed asset turnover, the total asset turnover, long-term debt to equity, turn on equity, return on assets, the return on investment, cash flow per share, net operations working capital, the total net operations capital, free cash flow, net operations profit after tax across gross in investment and operation capital and return on investment capital and operation cash flow. We analyzed each of these financial pyramids, and I gave it a 5-year time series to analyze Sony and as the primary company, and this competitor being Nintendo in this case. But before we continue, let's talk a little bit about the companies. First of all, Sony was founded in May 7, 1946, and its founders being Masaru Ibuka and Akio Morata, and its headquarters are located in Tokyo, Japan. Some of its products that are offered by the company include the computer hardwares, cameras, consumer electronics, music, films, robots, semiconductors, TV films, telecommunication equipment, and video games. Now, also in 2021, the magazine Fortune Global listed it on the top 500 list across the world. But more importantly, it was situated in the 100 biggest companies in the world and position in the position 88. The other company of our interest is Nintendo Corporation Limited, a multinational corporation founded on the 23rd of September, 1886. And its headquarters are located in Kyoto, Japan. Its founder, Fusajiro Yamauchi, and some of the products that are mainly that Nintendo usually focuses on is video games and electronics. Some of the biggest consoles that Nintendo has been able to offer to the world community has been some systems, including the Super Nintendo Entertainment System, the Game Boy, Switch, and the Nintendo DS, and of course the Wii. Over the years, the company has grown on its total assets, equity, and revenue, making it one of the most valuable companies in Japan. The company prides itself on on having received various awards, such as the British Academy Game Award, also the Emmy Awards for Technology and Engineering Gaming Awards. And now let's jump straight into the analysis of these companies. And when we look at it, one of the first things that we're going to start with is the after-tax cost of debt. So the formula for to calculate the after-tax cost of debt is the following, which is after-tax cost of debt equals to before tax cost of debt, the rate times 1 minus tax rates, where the before tax cost of debt is equal to the interest expense divided by the total debt. The total debt is the same as the total liabilities, and the lower the cost of debt, the better for the company. In our calculations, as shown in the table below, the company has both companies have very low levels of cost of debt, which is a good thing for financial uh, indicators, as we can see in the tables. Some of the companies across the past 5 years, some of the margins have not changed. If it has changed, it changes for very little margins. And the next thing that we're going to look at is the cost of the preferred stock of the company. The this it can be described as the prime divided by the amount that a company pays their investors in order to convince them to invest in the preferred shares. Uh, from the definition, it means that most companies will prefer to use less money to attract potential investors. Therefore, the lower the cost of the preferred stock, the better. The formula to obtain the cost it's as follow, which is it equals to the annual dividends divided by the market price of stocks, where market price per share of the common stock equals to the stockholder equity divided by the outstanding stock shares. The table below shows Sony and Nintendo cost of preferred stocks calculated representatively. And when we look at Sony, the cost of the preferred stock was lower on the 31st of March of the year 2022 at a figure of 152.74. The lower cost is an advantage to the company, and it means that the company is more attractive to investors, and that it doesn't have to spend more in pursuing investors to invest in the preferred shares. Now, when we look at Nintendo, the cost of preferred stock is lower than Sony's, perhaps due to the difference in size of the company and the number of preferred shares available to the potential investors. However, a single analysis of Nintendo cost of preferred stock shows a significant increase since 2018, uh, from a figure of 62.66, as we can see in the table in 2018, to the current 139.87. This implies that it is now expensive for the company to attract more of their investors. And when we look at the cost of equity, we look at the internal cost of equity, but usually, as we can see in the table, the cost of is a form of return that the company pays their equity investors in order to cushion them from investing in riskier stuff. It is healthier for the business to have lower costs of equity. However, for riskier investors, firms tend to use more resources to pay the investors to offset risk. So from the investors' angle, they will most likely have to be paid more to cushion from their losses. Will While from the business perspective, they will always prefer to have a lower cost as possible. There are too many methods of determining the cost of equity, the dividends valuation model, and the capital asset prime model, which we're gonna look at right now. But when we look at this, according to the individual value model, which is going to be the one that I'm focusing right now, we calculate the cost of equity using the formula PE equals D1 divided by P0 plus G. In this case, KE being the cost of equity, D1 the expected EPS for the next year times its dividends payout rate, and P0 being the current market price. G being expected growth rate. The table below shows that the cost of equity for Sony Group Corporation and Nintendo is very respectively. And apart from 2022, where Nintendo had a lower cost of equity than Sony, all of the other the all of the other years, the company had a significant higher cost of equity than Sony. This means that Sony uses fewer resources to attract investors. Now, the next thing that we're going to look at is the capital asset prime model. And in this in this model, we calculate the cost of equity using the formula TE equals to RF plus beta in parentheses RM minus RF, where KE being the cost of equity, the RF being the risk-free rate, RM expected return on the market, and the R being the return being the return being current price divided by the previous price minus one. The risk-free rates, according to the financial data retrieved from Bloomberg, is 3.88 and beta. According to the finance.yahoo is 0.88 for Sony and 0.47 for Nintendo, excuse me. The expected return on the market are obtained by calculating the geometry means of the returns. The table below shows the cost of the equity for the two companies are determined by the CAPM approach. And when we look at it, we can see that the cost of equity for Sony, according to the capital assets prime price model, is higher than that of Nintendo. The next one, we're gonna look at the expected equity of capital, which is the equation that I mentioned earlier. Now we're gonna look at the current capital structure. The capital structure of the company can be analyzed using various financial parameters. And in my case, I shall use the debt to equity ratio to yes, the ratio shows a company's ability to pay its dividends, and it is calculated by taking the total liabilities and dividends, dividing it by the total equity. A high debt to equity ratio shows that a firm is highly relying on the debt financing and might be considering a high risk venture. It therefore means that companies should always strive to have its debt to equity ratio as a reasonable lower rate. The table below shows between Nintendo and Sony the debt to equity ratios of the two companies. In 2022, Sony recovered the lowest ratio at 3.26, and the company's the company's debt equity has been reduced since 2018, which is a positive financial indicator that has convinced potential investors that the company is becoming less reliant on its debt finances. And on the other hand, despite the decreased figures of Sony, it shows that the higher DE rate as compared to a Nintendo, and therefore, if this was a perimeter to use by an investor, the investor itself would most likely choose Nintendo over Sony due to the low risk and the result less reliable on debt financing. Now, there's a couple of more equations and more formulas that were utilized to facilitate this analysis. Some of them are focusing more on the financial aspect and some on the accounting, but the one that we are going to look at is the accounting aspect of these equations. And the first one that we're going to look at is the total net operation capital. And this is the accounting measurements that we're going to be focusing now in this portion of the analysis. Now, the total net operation capital is the accounting measures that represents the current and non current assets, and it is calculated by subtracting the current liabilities from the current assets. And we can also calculate its use, it's using by using the following formula, which is that the total net operation capital equals the net operation work capital plus non-current operation assets, where net operation working capital it's equal to the operation current assets minus operation current liabilities. From the formula, we can effectively calculate that the total net operations capital as shown in the table below. Um, the total net operation capital of Sony has been on a steady increase since 2018, actually, and an increase in the total net operation capital is significantly, as it shows us that the company has short-term resources that are used to day-to-day production activities. This implies that the company is able to sustain its production activities and in our operations. But it is also important to compare to the performance of Sony net operations capital to its competitors, in this case being Nintendo. And its figures are shown in the table right under it, which indicates that the total net operations capital for Nintendo has equally been on a steady rise from 2018 and to like present year 2022. Significantly, the company ability to sustain their operations has been very productive. Part of it is being in 2018 was one of the years where they launched one of their biggest and most successful products, being the Nintendo Switch, which allowed its users to not only play having a console that can be taken different places. It is more portable, but it also like brought a rebirth for the company as far as its products, and it shows right here when it comes within their numbers and capital. However, upon a comparison between the two companies, Sony has significantly higher total net operation capital than Nintendo. And in this regards, we can say that Sony has a more has more ability and capacity to maintain the day-to-day operations. The next, and now that we talk about the operations, the next part of the analysis in the accounting portion of this is the net operation working capital. The net operation working capital is also an accounting measure that shows the difference between the non-interest bearing operation assets and the non-interest operations liabilities. What I can also deduct from this is that it shows the ability of a business or a company to play its current operations liability using the current operations assets. The formula that is used to calculate the net operation working capital is the following. It is equal to the current operation assets minus the current operation liabilities, where current operation assets is equal to cash plus account receivables plus the inventory, and the current operation liabilities being the account payables plus accurate expenses. And the two tables below show the net capital for both Sony and Nintendo in the past 5 years. And if we take a closer look, the net operation working capital dropped between 2018 and 2019 from 1,357,727 25 to 1,029,421. After which it took a steady increase in the subsequent years, meaning that the ability of the company to pay its current operation liability from its current operation asset has been on a steady increase. The competitor has equally recorded an increase on its net operation working capital for the past 5 years, as we can see. The most recent net operation working capital of the two competitors, the competitor company, shows that Sony has the upper hand in this instant at a 2 million 531,518, while Nintendo has just closely and rounding to a 1,400,866. This means that as this year 2022, Sony has more ability to meet its current operation liabilities compared to its competitor. Now, the gross investment in operations capital is is described as a capital expenditure to lease, improve or acquire property to be used in operation and operating a business. We can calculate the gross in investment in operation capital using the following formula, which is right there labeled, which it's gross investment in operation capital. It's equal to the net operation working capital plus fixed assets plus the accumulated depreciation and amortization. Sorry. The table below shows as well both Nintendo and Sony for the past 5 years, and the figure in the table above shows that in this table shows that Sony has had an increased growth investment in operation capital. This implies that more investment has been channeled into a company. The company has equally had an increasing level of gross investment operation capital as shown in the table below. However, there is a wide variance between the level of investment in the two companies. The higher level of the gross investment in operation capital in Nintendo is 2,016,026 Japanese yens, while that of Sony is at 29,374,934 Japanese yens. From this, we are able to establish the size of the company, and for the margins of it, we can see that Sony is largely a bigger company and clearly a more substantial when it comes to when we talk about the terms of raw investment in operations capital. But one thing that it's very important to notice is that not only is the economy always being affected directly by companies, but also the government can take advantage from these companies being through taxation. And one of the things that we had to always consider is that taxation takes place an important part in every company, because sometimes the company, the different types of taxations are in place, and in some cases it takes take a bigger toll on the company. Now, and this is a measurement that shows a company's theoretical income from the day-to-day operations if there was no debt from its capital structures. We can also use this accounting measures to determine and compare the profitability of different companies in other cases. Sony Corporation Group and Group Corporation and Nintendo Company Limited. And excuse me, its formula it's the following, which is net operations profit after tax. It is equal to earnings before interest and tax EBIT times 1 minus tax rates. Or it can also be used as net operation profit after tax equals to the operation income times 1 minus tax rates. And as we can see in the table below, the company's lower notepad is was in 2018 at 573,338 million Japanese yens, while the highest was 950,569 million Japanese yens in the year of 2022. The profitability of Sony has been increasing in the past 5 years. It is also important to make with a comparison with the notepad work for performance of Nintendo. As a result of this, I calculated the notepad from 2018 to 2022 as the show in the table below. And it just like Sony Group, Nintendo also has an increase in notepad with the 5 year period. However, a comparison between the two companies shows that Sony still it has a higher notepad value than Nintendo. We can therefore conclude that Sony has been more profitable in the past 5 years. And that can be understandable due to its size. The next thing we're going to talk about is the return on investment capital, which it can be identified as follow, which is return on investment capital equal to net operations profit. Net operations profit after tax divided by the investments capital, where invest capital is equal to the current assets minus the current liabilities. And for what we can see in the table, they had very similar. Their 2018 for Sony at least has had one of the most noticeable rates compared to the year 2022, which shows an increase in their their return on investment capital. They have reduced in numbers. And when we look at, and in fact, they're actually negative numbers. And when we look at Nintendo, we can see that from the ROIB data from Sony, as because it's negative since 2018 to the year, we can say that the company is not effectively using its capital to generate profit. This is mainly because the company current liabilities are more than the current assets. The competitor, in the other hand, has a positive ROIC, as shown in the table below. This implies that the company is able to generate profit from its capital investments. The higher level of ROIC was in 2021 at 0.30, while the lowest in 2018 was 0.12. And for this, and to be close to towards the end, we're gonna talk about one of the last things, which is the weighted average cost of the capital. And this rates it's an indicator at which a firm's business it's supposed to pay to their shareholders, which is and to finance its assets. And that's one of the biggest priorities of every company or corporation, is to be able to maintain their shareholders. The formula it's used as follow, which is equal to KD parenthesis 1 minus T, and D divided by B plus KE parenthesis E divided by V, where KD is equal to the cost of the debt, KE being the cost of ordinary equity, T equal to the margin company tax rates, D being the market value of debt, E being the market value of the ordinary equity, and V being the value of the company in the market, or market value of the company. And the table below shows it also shows the calculations of both Sony and Nintendo. And when we look at this table, in order to come for companies to create a value for investors, they should strive to have a lower weighted um, average capital cost. Investors feel more secure investing in a company which has a lower average cost of capital. Um, as such, companies are more stable, or rather, are less risky to invest on. The WAC is also important for business to analyze for business analysis, as it helps them make a comparison on whether or not they they invest in a certain business operations. When a certain business operation is expected to yield more return than the cost of capital, then it is rational to proceed and invest and also in this opportunity. From the table below, we can see that Sony has a higher level of WAG in 2019. We can see that it has a higher number in the return on the value of equity. Their lowers being a pretty steady number in comparison to what what it has been for Nintendo in the past 5 years, which for Sony it has all been very steady numbers, and the margin just has changed by probably once by 0.0001 within the past 5 years, which is an incredible number to maintain in comparison to Nintendo, where their numbers are in fact negative. And in this case, we can see that the upper hand is held by Sony. And when we look at also when we want to look also at the market value of the company, it is calculated by the number of shares times the price of the current price per share. And when we look at most of the companies since 2018, it has a higher market value since 2018, being 61,170.64 Japanese yens. And in the current, as in this year, uh, Sony's market value has gone from that number to 127,052 and 52 Japanese yens with 68 cents. And on the other hand, we can see the incredible difference in margin when we look at the other companies. Now, in this case, the market value of Nintendo has been not as steady and consistent as one by Sony, and the first year being 6,666 Japanese yens with 88 98 cents. And when we look at it, in fact, it has not been steady. It has gone up and down by relatively a quite noticeable number. So it has not been steady since then. And in this case, it shows that the market value of Sony has been it's higher than and more consistent than Nintendo. And to conclude all of this, we have to know that in the field of finance, there are many measurements that the companies can use to efficiently analyze its financial health. Uh, the analysis is critical to decide to make decisions for both the management, the shareholders, and future investors. Um, and this report also has shown us a pool of financial ratios and accounting measurements that has been used on Sony Group Corporation and Nintendo Company Limited. The financial parameters after affect different aspects of business operations, and therefore the company between the two, the comparison between the two companies, sorry, we are competing in the same industry is key to ensure that the company can be productive and productive financially in their financial status, so that they can compete in the market and hopefully grow in their respective market shares and also in their industries. And with that, I will conclude this. Thank you very much for your time.